There is a cycle in history so consistent that it has outlived empires, ideologies, and technologies. Every global reserve currency has followed it. Not most, not the careless ones, every single one. They rose to dominance, shaped the world economy for a generation, and then quietly lost the very power that made them untouchable. The Portuguese real commanded global trade for decades before fading into irrelevance. The Dutch guilder ruled the financial world and then surrendered its position. The British pound stood at the center of the global system for over a century until it didn't. Different nations, different centuries. The same outcome. Each currency moved through the same sequence of stages. Each believed its system was stronger, more advanced, more permanent than those that came before. And each discovered, too late, that permanence was an illusion. The U.S. dollar became the world's reserve currency in 1944. That was more than 80 years ago. Today, it has entered the late stages of the same cycle that ended every reserve currency before it. This is not a prediction. It is not a political argument. It is the arithmetic of systems that grow large enough to govern the world. This cycle has played out 4 times across 6 centuries. And the only question left is whether we are willing to recognize the pattern or whether we will repeat the oldest mistake in history and insist that this time is different. Before examining the stages themselves, one thing must be clear. A reserve currency is not simply a strong currency. It is the currency other nations must hold, must trade in, and must rely upon to function. It prices global commodities. It settles international trade. It fills the vaults of central banks. When a currency holds this position, the world does not just prefer it, it depends on it. And that dependency grants extraordinary power, privileges that lift empires and, in time, pull them apart. Now we will move on to the 7 stages. Stage 1 is military dominance combined with control over critical trade routes. Reserve currencies are born not because markets vote for them, but because commerce is forced to flow through the networks their issuing nations control. When a single power can secure sea lanes, ports, and choke points, its currency becomes the medium trade must use, regardless of preference. Stage 2 follows naturally. Large and persistent trade surpluses. With commerce routed through its system, the reserve issuing nation exports more than it imports and accumulates real wealth, gold, capital, infrastructure, and productive capacity. This is the period remembered as a golden age. Prosperity appears earned, sustainable, and self-reinforcing. Stage 3 is the peak, the moment the world formalizes what has already become reality. Treaties are signed, contracts denominated, reserves held. The currency is no longer just widely used, it is officially crowned. Yet this recognition marks a turning point. Once global demand shifts from goods to the currency itself, the internal balance begins to break. Stage 4 is the reversal. Production gives way to consumption. Trade surpluses turn into deficits that persist year after year. The issuing nation discovers it can import real goods in exchange for financial claims, and the incentive to maintain domestic manufacturing weakens. Wealth is no longer created at the same pace it is spent. Stage 5 arrives when deficits and debt can no longer be financed through borrowing alone. Money is created to bridge the gap. Whether through debasement of coin or expansion of fiat supply, the result is the same: dilution of purchasing power. Inflation appears, at first dismissed as temporary. Stage 6 is the loss of confidence. Foreign holders begin to question the currency's stability and search for alternatives. Reserves are diversified, contracts rewritten, trust quietly withdrawn. Finally, Stage 7 completes the cycle. The currency is replaced not by decree, but by collective abandonment. What follows is not collapse by explosion, but by substitution. This is how reserve currencies end, not suddenly, but decisively. Once the 7-stage cycle is understood, the next question becomes unavoidable. Why does holding the reserve currency matter so much in the first place? The answer lies not in symbolism or prestige, but in function. A global reserve currency is the operating system of the world economy. It is the unit in which international trade is settled, the measure by which commodities are priced, and the asset other nations store in their central bank vaults to protect themselves from crisis. When a currency becomes the reserve, it occupies every critical layer of global exchange. Oil, grain, metals, and energy are priced in it. Cross-border loans are denominated in it. Trade imbalances are settled through it. This means that countries do not simply prefer the reserve currency, they require it. To import essentials, to stabilize their own currencies, and to participate in global markets, they must hold and use the reserve issuer's money. Demand for the currency becomes structural rather than optional. This creates what economists call the exorbitant privilege. The nation issuing the reserve currency gains the unique ability to purchase real goods and services by creating financial claims. While other countries must export labor, resources, or manufactured products to earn foreign currency, the reserve issuer can produce money itself and exchange it for tangible wealth. This is not exploitation in the conspiratorial sense. It is a systemic outcome. The rules of the system reward the issuer simply for being at the center. The privilege extends beyond trade. Because foreign governments and institutions need safe reserve assets, they hold the issuer's bonds. This produces constant, global demand for its debt, allowing the reserve country to borrow at lower interest rates and in far greater quantities than any other nation could sustain. Deficits that would cripple smaller economies become manageable, even invisible, when the world is required to finance them. For a time, this arrangement appears miraculous. Living standards rise. Consumption expands. Financial markets deepen. But the same mechanism that enables abundance also removes discipline. When money can be created to acquire real output, the incentive to produce that output domestically weakens. The reserve currency becomes less a mirror of productive strength and more a claim on the productivity of others. This is why the role of the reserve currency is inseparable from its eventual decline. The privilege is real, powerful, and temporary. It does not fail because it is misused, but because it works too well for too long. The privileges of reserve status do not appear spontaneously. They are earned in the early phase of the cycle, during a period defined by power, discipline, and extraordinary productivity. This is the first great chapter of every reserve currency's life, the era of control and accumulation. Before deficits, before debasement, there is dominance and with it, genuine prosperity. In this initial stage, rising empires do not yet live off the system. They build it. Military strength is not abstract but logistical. Trade routes are secured, choke points controlled, and commerce protected or denied at will. This control forces global exchange to flow through a limited number of gateways, all governed by the same power. Once trade depends on those routes, it naturally depends on the currency that circulates within them. Portugal demonstrated this pattern in the 15th and 16th centuries. By mastering open ocean navigation and fortifying strategic ports, it redirected global trade away from land routes and into seas it dominated. Spices, silk, and precious goods moved through Portuguese-controlled channels, generating enormous trade surpluses. Wealth accumulated rapidly, and Lisbon became a hub of global exchange. The Dutch refined the model rather than reinventing it. In the 17th century, the Netherlands combined naval power with financial innovation. Amsterdam did not merely host trade, it centralized it. Goods from every continent passed through Dutch hands, allowing the Republic to capture margins at each step. The guilder gained prominence not because of decree, but because Dutch markets were the deepest and most reliable in the world. Britain expanded the same logic to an industrial scale. Control of sea lanes, combined with mechanized production, allowed Britain to export manufactured goods globally while importing raw materials cheaply. The result was the largest and most sustained trade surplus of its era. London became the clearinghouse of global capital, and British wealth compounded for generations. The United States inherited this position after World War II under unique conditions. With competitors physically destroyed and its own infrastructure intact, America dominated both production and logistics. Its factories supplied the world, its navy secured global trade, and its economy absorbed surplus capital from abroad. For decades, the United States ran enormous trade surpluses, accumulating gold, influence, and unmatched financial power. This stage is remembered nostalgically because it is real. Growth is earned. Wealth is tangible. Confidence is justified. Yet it is also fleeting. The very success of this phase plants the conditions for transition. Once accumulation peaks and the currency's role expands beyond trade into finance and reserves, the incentives shift. Prosperity gives way to complacency, and the cycle, quietly but inevitably, moves forward. The moment of greatest success is also the moment the direction quietly changes. After the era of control and accumulation comes a turning point that no reserve currency has ever reversed. When reserve status is formally recognized and fully embraced by the world, the economic logic governing the issuing nation begins to shift in ways that are subtle at first, but ultimately irreversible. Once a currency becomes the official reserve, global demand no longer centers on the country's goods alone, it centers on its money. Foreign governments, banks, and corporations need the currency itself to hold as reserves, to settle imbalances, and to denominate contracts. This demand alters incentives at the deepest level of the economy. Exporting products becomes less important than exporting financial claims. The nation discovers it can import real goods not by producing competitively, but by issuing currency and debt that the world eagerly absorbs. This is the essence of the Triffin dilemma. For the global system to function, the reserve-issuing country must supply the world with liquidity. That means running trade deficits, sending currency abroad in exchange for goods. But those same deficits steadily erode the productive base that once supported the currency's strength. The system demands imbalance, and the issuer cannot satisfy global demand without undermining itself. Production gradually gives way to consumption. Manufacturing shifts offshore, where labor is cheaper and margins higher. Domestic economies reorient toward services, finance, and asset management. On paper, the nation appears richer than ever. Living standards rise, credit expands, and imports flood the market. The trade balance, once a source of strength, turns permanently negative. Crucially, this transition does not feel like decline. It feels like efficiency. Why maintain difficult, capital-intensive industries when foreign producers are willing to supply goods cheaply? Why restrain spending when borrowing costs remain low and global demand for debt appears endless? Political and corporate incentives align toward comfort, not resilience. History shows that this is the point of no return. Portugal financed consumption with colonial gold. The Dutch lived off accumulated capital and financial income. Britain relied on returns from overseas investments long after its factories lost competitiveness. In each case, the shift was rational, gradual, and widely praised at the time. Yet, the mathematics were unforgiving. A nation cannot remain the world's producer and its consumer indefinitely. Once the reserve currency issuer becomes structurally dependent on deficits, reversal would require sustained trade surpluses, reduced consumption, and economic pain lasting decades. No society has ever chosen that path voluntarily. This is why the turning point matters. It is not marked by crisis, but by comfort. And once crossed, the cycle no longer asks whether decline will occur, only how long it will take to complete. Once permanent deficits are normalized, the next phase does not arrive by choice. It arrives by necessity. When borrowing alone can no longer sustain the gap between what a nation consumes and what it produces, monetary integrity becomes the pressure valve. This is the stage where fiscal imbalance turns into monetary decay, and where confidence slowly, then suddenly begins to erode. At first, the response appears technical rather than dramatic. Governments and central banks expand the money supply to stabilize markets, support growth, and prevent contraction. Whether this takes the form of debasing coinage in earlier centuries or expanding fiat balances in the modern era, the mechanism is the same. More currency is created to cover obligations that production can no longer meet. The immediate effects feel benign. Asset prices rise. Crises are deferred. Stability appears restored. But money creation carries a cost that cannot be eliminated, only delayed. As the supply of currency grows faster than the supply of real goods, purchasing power declines. Prices rise. Savings buy less. Wages lag behind costs. Inflation, initially dismissed as temporary or external, becomes embedded in daily life. This is not a policy failure. It is arithmetic. Too many claims are chasing too few outputs. As inflation persists, trust weakens. Foreign holders of the currency, central banks, sovereign funds, and international lenders begin reassessing their exposure. They do not panic, but they reposition. Reserves are diversified incrementally. Gold holdings increase. Trade contracts experiment with alternative currencies. Each individual move appears small, even prudent. Collectively, they signal a shift in belief. This loss of confidence is the true inflection point. Reserve currencies do not lose their status because alternatives are perfect. They lose it because the existing system becomes unreliable. Portugal's real was abandoned not because Spanish silver was ideologically superior, but because it held value more consistently. The Dutch guilder faded as London's markets proved deeper. The British pound declined as repeated devaluations made long-term contracts untenable. Importantly, this stage unfolds quietly. There is no announcement that trust has been withdrawn, no formal vote. Confidence simply stops compounding. What once felt unquestionable begins to require justification, and when a currency must be defended with explanations rather than performance, the cycle has entered its final stretch. From this point forward, momentum works in only one direction. The search for alternatives accelerates, and the foundations of replacement are laid long before the old standard officially falls. When viewed through the lens of this historical sequence, the current position of the US dollar becomes difficult to dismiss as coincidence. The same signals that marked the late stages of previous reserve currencies are now visible, not in isolation, but in combination. The dollar has already crossed the threshold of large-scale monetary expansion, and it is beginning to encounter the more consequential phase, the gradual withdrawal of confidence. The turning point arrived during the financial crisis of 2008, when extraordinary measures became normalized. To prevent systemic collapse, the Federal Reserve expanded its balance sheet on a scale without historical precedent in peacetime. What was initially framed as an emergency response soon became a standing tool of policy. A decade later, the pandemic accelerated this trajectory dramatically. Trillions of dollars were created in a matter of months, permanently altering the relationship between fiscal deficits and monetary discipline. The effects were predictable. Asset prices surged, while the purchasing power of the currency eroded. Inflation, long assumed to be a relic of the past, returned with force. More important than domestic prices, however, was the signal sent abroad. For the first time in generations, holders of dollar reserves had to confront a simple reality. The value of their assets was being diluted by decisions over which they had no control. As in previous cycles, the response has not been abrupt abandonment but measured diversification. Central banks have been steadily reducing the share of their reserves held in dollars, reallocating toward gold and alternative currencies. This shift is incremental, not dramatic, but its direction is consistent. Gold purchases by central banks have reached levels unseen in decades. Bilateral trade agreements increasingly bypass the dollar altogether. Energy and commodity transactions, once universally dollar-denominated, are beginning to experiment with other units of account. These developments do not signal imminent collapse, they signal repositioning. The world is preparing for a future in which the dollar no longer occupies its singular role. History suggests that this stage unfolds over years, not months. Confidence does not vanish overnight. It thins. Liquidity remains, but loyalty fades. What makes this moment uniquely consequential is scale. Unlike earlier reserve currencies, the dollar is embedded in every layer of the global financial system. Its decline is therefore not a regional event, but a systemic one. The same forces that elevated it now ensure that its late-stage transition will be broader, more complex, and more disruptive than anything before. The pattern has reached its closing chapters. The question is no longer whether the cycle applies to the dollar, but how the world will navigate the final stages of its unwinding. As the dollar's late-stage signals become clearer, a natural question follows. If the current reserve currency is weakening, what replaces it? History suggests that decline and succession are usually linked, with a rising power ready to assume the role as the old standard fades. This time, however, the pattern diverges in an important way. There is no obvious heir waiting in the wings. A successful reserve currency requires more than size or ambition. It must be supported by deep and liquid financial markets, free capital movement, legal predictability, military protection of trade routes, and a productive economy capable of supplying the world. Today, no single currency satisfies all of these conditions simultaneously. The absence of a clear successor is not a temporary oversight. It is a structural reality. China, often cited as the most likely challenger, illustrates the problem. It possesses immense productive capacity and runs persistent trade surpluses, yet its financial system remains tightly controlled. Capital cannot move freely in and out of the country, legal transparency is limited, and trust in long-term convertibility is constrained by political discretion. A currency cannot function as a global reserve if holders fear they may not be able to access or move their assets during stress. The euro, while widely used, suffers from a different weakness. It represents a monetary union without a unified fiscal authority. Divergent economic conditions across member states, demographic pressures, and political fragmentation limit its ability to absorb global reserve demand. In moments of crisis, the euro's internal fault lines become visible, undermining its claim to singular dominance. Gold, increasingly favored by central banks, offers stability but not scalability. It preserves value and resists debasement, yet it cannot support the volume or speed of modern global trade. Digital assets and cryptocurrencies present technological novelty, but they lack sovereign backing and face regulatory resistance. They challenge existing systems but do not yet replace them. The result is a world drifting toward monetary multipolarity. Instead of one dominant reserve currency, multiple currencies may coexist, each serving regional or functional roles. Trade blocs may settle transactions in local units, while neutral assets like gold or baskets of currencies are used for interbloc settlement. This transition is unlikely to be smooth. Competing standards increase volatility, reduce efficiency, and amplify financial instability. Periods without a clear monetary anchor are historically turbulent. Exchange rates fluctuate, capital flows become erratic, and trust fractures along geopolitical lines. In this sense, the absence of a successor may prove more destabilizing than the decline of the dollar itself. The system is not merely changing leaders, it is losing its center. The absence of a clear successor does not soften the consequences of decline, it magnifies them. When a reserve currency fades without an orderly replacement, The costs are not confined to the issuing nation. They spread through every balance sheet tied to the system. Because the US dollar sits at the core of global finance, its deterioration carries global consequences that extend far beyond exchange rates or trade statistics. For governments, the impact begins with reserves. Central banks around the world hold trillions of dollars in US assets as a foundation of financial stability. As the dollar's purchasing power erodes, those reserves lose real value. This weakens national balance sheets and reduces the capacity to respond to crises. For countries with dollar-denominated debt, the transition becomes even more dangerous. Volatility in the dollar raises refinancing costs and increases the risk of default, particularly for emerging markets that borrowed heavily in the assumption of long-term stability. Corporations face similar pressures. Global firms have issued vast amounts of dollar-denominated bonds because the system encouraged it. As confidence thins and monetary conditions shift, these liabilities become harder to roll over. Investment slows. Hiring contracts. Financial stress propagates through supply chains, affecting regions far removed from the United States itself. The most severe consequences, however, are felt at the household level. Currency decline expresses itself not as abstract financial theory, but as higher prices, stagnant wages, and eroding savings. Inflation acts as a silent transfer of wealth from savers to debtors. Pensions denominated in dollars lose purchasing power. Fixed incomes buy less each year. What appears as gradual inflation is, over time, a restructuring of living standards. History shows that these transitions are rarely neutral. When the British pound lost reserve status, an entire generation in the United Kingdom experienced a lasting decline in global purchasing power. The process did not unfold as a single crash, but as a series of adjustments that permanently lowered expectations. The dollar's reach today is far wider, and so are the implications. Because the dollar anchors commodity pricing, capital markets, and cross-border lending, its instability introduces friction everywhere. Trade becomes more expensive. Planning horizons shorten. Trust between counterparties weakens. In a multipolar monetary world, uncertainty replaces efficiency. This is why the decline of a reserve currency is not merely a national event. It is a systemic one. When the dollar weakens, the shock is transmitted through the entire global financial architecture, quietly reshaping wealth, opportunity, and economic security across continents. When the consequences are viewed in their full global context, one final point becomes unavoidable. This is not a debate about politics, ideology, or national virtue. It is a historical cycle that has repeated with remarkable consistency, regardless of the beliefs or intentions of those living through it. Empires do not choose this path, and currencies do not decline because of moral failure. They follow structural incentives that over time produce the same outcome. Throughout history, those who suffered most during reserve currency transitions were not the reckless or the uninformed, but the complacent. They assumed permanence where none existed. They trusted continuity because it had lasted longer than a lifetime. By contrast, those who recognized the pattern early did not predict exact dates or dramatic collapses. They adjusted gradually. They diversified exposure, reduced dependence on a single monetary system, and positioned themselves to preserve purchasing power rather than chase nominal stability. This distinction matters because late-stage decline rarely announces itself with clarity. It unfolds through a series of rationalized decisions: temporary stimulus, emergency measures, exceptional policies that quietly become permanent. Each step appears justified in isolation. Only when viewed as part of a longer arc does the direction become clear. History does not warn with sirens, it signals with repetition. Understanding this cycle does not require pessimism or panic. It requires realism. The goal is not to flee the system, but to recognize its limits. Holding all wealth, savings, and expectations within a single currency that has entered its late stages carries risk, not safety. Adjusting for that reality is not an act of defiance, it is an act of prudence. Every previous transition rewarded those who paid attention before consensus formed. Portuguese merchants who shifted into Spanish silver, Dutch financiers who moved capital to London, and British elites who repositioned into dollar assets all acted before the change became obvious. They did not resist history, they aligned with it. The final message is therefore simple and unsentimental. Cycles do not care about belief, they complete themselves. The only meaningful choice available to individuals and institutions is whether to recognize the pattern early or to deny it until adjustment is no longer possible. If this breakdown changed how you see the dollar, global power, or where the system may be heading, share your thoughts in the comments below. Your perspective matters. And if you found real value here, subscribe to the channel so you don't miss the next chapter as this cycle continues to unfold.